All right. Greetings to everyone. You're all welcome to our channel. Here is Pros and Cons, and my name is Edward. All right. So we want to continue with our session on consolidation, or let me say business combination. So as we met the last time, we talk about the overview of consolidation. We talk about also the overview of the mechanics of consolidation, talking about the introduction session to the mechanics of consolidation. And talking about the mechanics, we talk about the group structure, the cost of consideration, or what somebody would say cost of investment. We talk about the one of the mechanics to be the date of acquisition and date of reporting. Then we also made mention of the net asset schedule of the subsidiary. We talk about goodwill, the group retained earning, and the non-controlling interest. Today, we want to focus on the group structure and the cash and deferred consideration. So the group structure being one part of the mechanics, and also cost of consideration also being one part of the mechanics. As I mentioned the last time, the consideration, we have about 6 types of the consideration. We will have the cash consideration, the deferred consideration, contingent consideration, transfer of assets. We have the loan consideration and also the share exchange consideration. Today, our focus will be on the first mechanic, which is the group structure. And for the consideration, we'll be talking about the cash consideration and the deferred consideration. Now, as an overview, of, let's say what we did the last time, let's look at the whole idea of the group structure. So we said the group structure is about the structure of the organization, meaning the percentage that the parent has been able to the parent actually purchased and what the NCI also purchased from the subsidiary. Normally, we say the subsidiary is 100%. So the parent will purchase their part and the subsidiary will also purchase their part. If you can remember, I made mention that those writing level 2, the group structure is very easy. If let's say you are writing ICA or ACCA, your group structure is very easy, regardless of the professional exam that you are writing. Your group structure may be very easy, even academia. But where you enter into corporate reporting, then the group structure starts to change. Because in a financial reporting paper, it's a direct group structure. It's a direct group structure. So it's just talking about the parent purchasing more than 50, whilst the rest will be for what? The NCI. But if you have a corporate reporting paper, surely the group structure may not, though not difficult, but may not be a direct one, as we may see in financial reporting. Now, for the group structure, as I said, we may have the parent, the direct one, where you have the parent purchasing the part of the subsidiary of, let's say, 70%, and in that case, gaining a control. So we say then the parent has a 70%, NCI has 30%, making the overall 100%, which is the subsidiary, right? Good. So this becomes our group structure. This is very direct. This is direct. So it makes it very, very simple. Now, there are some other cases. This is, as I said, financial reporting. There are some other cases where we may have even a D shape or V shape, anyhow it may come about, right? So how do we go by that? There's a situation whereby a parent will purchase the subsidiary and the subsidiary also purchasing another company. Let's say the subsidiary also purchasing what we call a subsidiary, right? So parent has purchased, let's say 70% here, whilst subsidiary has also purchased 40% here. while subsidiary has also purchased 40% in the sub-sub. Also, okay, so let's say subsidiary has purchased 90% of the sub-sub, right? Subsidiary has also purchased 90% of the sub-sub. Okay, now, because parent is controlling 70% in the subsidiary, then it means that whatever purchase that the subsidiary is also doing in another company, the parent controls what? 70% in it, right? Because I own you 70%. So whatever amount you are using in purchasing another company, it means that that amount I own what? 70% in it. I own 70% in it. That is the idea. All right. So this 90%, the parent has 70% in it. So in that case, it means the parent has uh, control. The parent may have either a control or may not have control in the subsidiary. We have to calculate to know whether the parent is having a control or not having control on the subsidiary. Let's do that. If I have 70% in whatever you purchase, then it means that I will have to calculate 70% of the 90% you've purchased in the sub-sub, right? And therefore, 70% times 90 will give us 63%. Will give us 63%. To give us 63%. In that case, it simply means that the parent has control over what? The subsidiary. Because the parent is owning what? 63% in the subsidiary. In the subsidiary. So this is a vertical method. This is vertical and very simple, also straightforward. Just that here, the sub is also purchasing another company, and therefore, parent will have to calculate their percentage in the subsidiary or in the other company that the sub is what purchasing to be sure if they have control on that company or they do not have control on that company. Now here we can see that the parent has control over that company. The parent has control over that company. What does that mean? Then it simply means that we will be able to what? Consolidate. We should be able to consolidate. We should be able to what? To consolidate. All right. So let's look at another scenario. So the other scenario is where, let's say, the subsidiary has purchased just 40%, but the parent also purchased 40% in the sub-sub. The parent also purchased 40%. Let's say the parent purchased 30% so that you don't get confused with the 40, 30% in the sub-sub. How do we get to know if the parent has control over the subsidiary or the parent does not have any control in that company? Right. So now, for the parent to know whether they have control or not, they will first have to calculate the percentage that they have in what the sub used in purchasing what the sub. So the sub purchased the sub 40%, and the parent owns the sub by what? 70%. So we have to calculate that 70%, right? Good. So first we are going to have parent having the 30% down. Then second, we will have to get the parent's interest in the sub. So that will be 70% on 40%. So 0.7 times 4 is giving us 28%. So 28%. 28%. So if we add 28 plus 30, we are getting 58. We are getting 58%. So what does that mean? Yet the parent has control over the subsidiary. Over the subsidiary. What if the parent, let's say, purchased just 20%? 20%. The parent purchased just what? 20%. In that case, it will not be up to the 58%. I'll try and see if we can get some questions. For now, let's make here 30%. If we can get some questions to elaborate on this so that we get more understanding to that. But this is what we call the D shape. The D shape. The other one was straightforward, but this one is a D shape. As I said, this normally happens when you are writing a paper called corporate reporting. Corporate reporting. Sometimes in academia, when you are doing financial reporting too, or if you are also writing corporate reporting, you may end up getting questions like this. But for now, the straight one, which is the financial reporting, that one is very easy for you to deal with. So you won't spend much time on that. Now, let us look at our cash and deferred consideration. First, we'll be looking at cash consideration. Then later on, we go on and look at what the deferred consideration. If you remember, last time I made mention that for cash consideration is very simple because I've purchased your company and I just gave you cash. So that ends everything, right? I just gave you cash. That ends everything. So what are we going to do? We purchase the company, give me the shares, I give you cash. That's all. But the focus is on what? Deferred consideration. Deferred consideration. So for deferred consideration, the last time we made mention that it is something that you pay, but you pay in future. And because you are going to pay in future and there's time value of money, you will have to bring it to the present so that we get to know the present value today. The present value what? Today. Because we need the consideration what today. We want to know the amount today in today's terms. So you bring it to the present. Now, let's go on and look at cash and deferred consideration. So, for cash consideration, I made mention that that is where you've purchased a company and then you paid what? Cash. So you are going to credit your cash and then debit what? Debit the cost of investment. So you credit cash and then debit what? Cost of investment or consideration. You debit your cash and then you credit your cash and then debit your cost of investment. Now, what happens here is that we are going to get a cost of investment or a consideration equivalent to the cash that you had, the cash that you gave out. But sometimes you may have a question where the consideration you are giving out includes some expenses. Let's say some legal expenses, operational expenses. These are expenditures and not actually part of the amount you are giving to what? To the shareholders or the amount you are giving to the company, the subsidiary company. So in that case, we have to take that we have to take that operational cost out. If it's a legal cost, we take it out. The leftover is what we are giving to what? What we are giving to the subsidiary company. So always we have to be careful. If you have a question which tells you that there's a consideration that you are paying, but that consideration includes some operational expenses or it includes some expenditures, all what you have to do is to take it out and know that the consideration is going to be the total amount less what? That operational expenses. And if it's an operational expenses, then surely it has to go to our P or L account or P or L account. It becomes a cost to us. It becomes a cost to us. So because it is the parent who is paying, the last time we made mention that in solving a consolidation question, assume that the group retained earning belongs to what? Even though it's for the group, assume that it belongs to the parent. So whatever cost that the parent is incurring, whatever gain that the parent is getting, put or recognize or in the group retained earning. So that is basically about cash consideration. Let's look at a scenario. Where is the scenario? Let's look at a scenario here, right? Okay. So looking at this question, we said pros and cons, that is pros and cons business combination, and this is our purchase consideration examples, right? So pros has a reporting date ending 31st December 2001 and acquired a subsidiary, cons, on 1st January 2001 under the following possible considerations. For cash consideration, the purchase consideration was an immediate cash payment of 5,000, which includes a legal fee of 200. So what then do we do? This is a legal fee. So legal fees is not amount you are giving to the sub company. You are paying it to lawyers or court or something, right? So you have to take it out from the 5,000, and then whatever will be left, you give it out as what a consideration or cost of investment to the subsidiary company. So this 200, what then are we going to do? We are going to debit this 200 in our P&L as well as our group retain earning, our group retain earning. Whilst we will credit what? We will credit the consideration you are paying out because we are going to subtract from it. So we credit the consideration you are paying. In this case, we will credit the 200 to the 5,000 that we are paying to reduce it, right? To reduce it so that it will go to our P&L and the group retain earning. Whether you take it to your P&L or that is if you are preparing a P&L account. If you have you can get a question whereby you are also preparing both P&L account and the financial position, right? So you will take it to your group retained earning and also to the P&L. So let's take that one into consideration. Okay. Now you've gotten your consideration, which is now 4,800. So that is the consideration. That is what the consideration. As I said, if your consideration has any expenditure, take it out from what the total consideration. Whatever will be left will be what the consideration or the cost of investment. Cash consideration, very simple. You shouldn't waste much time on the cash consideration. Now let's look at the deferred consideration. Let's look at deferred consideration. So looking at deferred consideration. So we made mention that it is an amount that you are paying to the subsidiary company, but you pay it in future. And because you are going to pay it in future, we have to find the present value today. But we need the consideration today. So we have to find the present value today, right? You have to find the present value today. Then whatever will be left, the last time we made mention that it's a finance cost. It's an amount you are going to use to finance the consideration that you've paid today, the present value today, so that you can get a total amount in future to pay to the company, right? So let's look at a scenario here and see how we will deal with the present value. If you don't know how to calculate the present value of an amount, let us try our hand. Now, for present value, we can say 1 over 1 plus r raised to the power n. N is the period. N is the period. So if it is 1 year, it is 1. If it is 2 years, you rate it to the power 2. If it is 3 years, it's 3, right? So it depends on the number of years that they would defer the consideration. So that is the years. N will be the number of years that they are deferring what the consideration. Let me say years rather. The number of years that they are deferring the consideration. Okay. Somebody will also say that, okay, for present value, we will use 1 plus r raised to the power negative n. 1 plus r raised to the power negative n. N still remains the number of years. And this 2 is the same thing. This 2 gives you what? The same thing. If that you go by 1, you go by 2, it will give you the same thing. So we multiply this by what? We multiply this by the consideration that we are paying. We multiply this by the consideration we are paying. All right. So let's have a scenario and then deal with it. Okay. So deferred consideration, we are saying that an amount of 5,400 has been deferred till 1st January 2000 and what? 1st January 2002, right? Plus cost of capital is 8% per annum. Yeah, cost of capital is 8% per what? Per annum. So what then do? We will have to bring this to the present because you have purchased the company and you said you are going to pay in what? You are going to pay on 1st January 2002. However, you purchased the company on 1st January 2001. So you will pay 1 year time. 1st January 2002 is almost this is the same as what? 31st December 2001. So 1 year time, we pay them 1 year time. So we have to bring the amount to the present for 1 year. We have to bring it to the present for 1 year. So let's go to our board and look at it. So we are saying that the deferred consideration, the total consideration is 5,400, right? And it has been deferred for 1 year. It has been deferred for 1 year. So the N is going to be 1. N is going to be 1. If we are using the second formula, N is going to be what? -1. N is going to be -1. So let's do with it. We have 1 over 1 plus R raised to the power 1 multiplied by 5,400. So the question you ask yourself is, what is the R? What is the R? R is equal to rate or cost of capital. R is rate, so the rate of capital or cost of capital, which will always which has to be given, right? So if you look at it, we have R, which is equal to what? The cost of capital. So let us show our scenario once again. The cost of capital was what? 8%. 8%. So we have to use 8% in finding what? The present value. So let's deal with that. So it means our R is equal to 8%. So 1 over 1 plus R, which is 8%, 0.08 raised to the power 1 multiplied by 5,400. And by doing that, we are going to get an amount of 5,000. You are going to get an amount of what? 5,000. An amount of 5,000. As I mentioned earlier, we will have to finance this 5,000. We will have to finance what? This 5,000. It's 1 year, so we have to finance it. So we calculate for what we call unwinding interest. Unwinding interest. And that unwinding interest, by calculation, it should be equal to what? The difference between this 5,000 and the 5,400. Let's look at the difference. The difference is what? 400, isn't it? The difference is 400. And this should be our unwinding interest. But please don't go to an exam hall and just find the difference. No, that's not how we do. We deal with it. So we will calculate for what we call the unwinding interest. And our unwinding interest is equal to 0.08 multiplied by the 5,000, which gives us 400, which will give us 400, right? It's going to give us 400. Now, I know you are asking questions. In your mind, you are asking questions that, oh, Ed, this time the person deferred for only 1 year. What if he deferred for 2 years, for 3 years, and the rest? So let's say this was deferred for 2 years. Let's say it was deferred for 2 years. Now, if it was deferred for 2 years, let's look at it. It means we are going to have 1 over 1 plus 0.08 raised to the power 2. right? Then we multiply by the 5,400. We multiply by 5,400. The question you ask yourself is, what are we going to get if it was 2 years? What are we going to get if it was 2 years? In 2 years' time, what is going to be the present value? Let's use our calculator. Divided by 1.08 raised to the power 2, which will give us, so times 5,400 will give us 4,630. So we are going to get 4,630. In fact, we are getting 4,629.6 something. But yeah, let's do it 4,630, right? We have deferred it for 2 years. So for the first year, what is going to be our unwinding interest? For year one, so unwinding interest year one is going to be 0.08 multiplied by 4,630. So times 0.08, that gives us 370. 370. Let's add plus 4,630, which will give us 5,000. 5,000, right? What about year two? So unwinding interest year two is going to give us 0.08 times 5,000, which is 400. So in total, we are going to pay 5,400 in year two. So that's why we said the difference is more or less an amount you are going to use in financing what? The present value, right? You have to finance the present value. And by financing the present value, we say calculate for a finance cost. And that finance cost is what we say an unwinding what? Interest. It is an unwinding interest that you are going to add up to the present value to pay the total amount that was deferred in future. Right, the total amount that was deferred in future. My focus is not even on calculating for the unwinding interest, but what to capture or what to recognize in the financial statement. It is we always have to be careful because this one, the person has deferred for 2 years. And you know that if you are preparing your financial statement, you prepare financial statement every year, right? We prepare financial statement every year. For example, your P&L, your P or L, sorry, your P or L is prepared yearly. Your P or L will be prepared what? Yearly. Now, the question someone is asking is, okay, so Ed, if I am preparing my P&L, should I take both the 370 and the 400 to the P&L or the P or L? The question is yes and no. Why yes and no? Yes, in the sense that yes, both the 370 and the 400 all has to be charged to P&L. All has to be charged to P&L. But remember, the first year one is 370 and the second year one is 400. So the 370 is what will be charged to the P&L for the first year. For the first year, if you are preparing your financial statement, because here the person deferred for 2 years. But in preparing your financial statement, surely the P&L will be prepared for just 1 year. For just 1 year. So which year P&L are you preparing? Yes, you have to prepare the first year before you go to the second year. So the first year P&L will have 370. That year's P&L will have what? 370. 370. So let's always be careful about that. So we are going to debit our P&L with an amount of what? 370. But don't also forget that when it comes to your financial position, your financial position is accumulated. It's accumulated figures. It takes into consideration accumulated figures, right? So the 370 and the 400 that you see all will have effect in the financial position. So at the end of the day, this amount will be in our financial position. The 5,400 will be in our financial position. So let's be careful with that because we know that an amount we have deferred is 5,400, right? So the financial position should have a certain amount of what? 5,400. 5,400. So basically, that is all on deferred consideration. I believe we've been able to do justice to what you were thinking about in your mind. Is that not it? So always know that if the person deferred for more years, the first one is what we are taking to our P&L when we are preparing P or L when we are preparing what? The first year statement. The first year statement. And because your financial position deals with what? Your financial position is dealing with all years, accumulation of years. We can take the total amount to the financial position. But someone will say, okay, the deferred consideration I know for the first year is 4630 plus the 370, right? That is fine, 5,000. But know that you also have an unwinding interest, which we can say, we can name it differently as an accrued interest in our financial position, an accrued interest in our financial position. So we can name the 400 as an accrued interest in the financial position. However, if you are preparing the second year P or L, then this 400 will have its effect in the financial, in the P or L. So this is all about deferred consideration by bringing the value or the amount deferred to the present, bringing the amount deferred to the present. Then once we bring it to the present, we calculate for what we call an unwinding interest. And then the unwinding interest is just the cost of capital, the same cost of capital that you use in bringing the value to the present. You use it to calculate for what? The unwinding interest on the present value. Now we are saying that the unwinding interest that you've calculated will have its effect in the P&L. Will have its effect in the P&L. Same amount can be added to what? To the present value and be taken to your financial position. If the person has deferred for 2 years, then it means our unwinding interest, we will have 2 times. We'll have two unwinding interest, right? The first year one surely will be taken to your P&L as we know. Let me add it up to the present value of the consideration. That can be taken to your financial position. But because there's a second year and your financial position is taking on accumulation of all figures, then we can calculate the second year unwinding interest on the total amount from the first year. The total amount from the first year. And also be taken still to our financial position. Well, somebody will add it to the total amount, or somebody will add it to the accumulated from first year. Somebody will also decide to separate it so that the second year unwinding interest will be named accrued interest, right? Besides, we can add both together and name it deferred consideration. Deferred consideration. My focus here today was for you to know cash consideration, deferred consideration, and the group structure. Well, if you have any question or any comment, please try as much as possible and then put it at the comment section, and we will be ready and to reach out to you anywhere you are. If it's about call, it's about commenting on whatever you have also posted, yes, we'll be able to do that for you. My name still remains Edward, and you can call me Ed for short. Here is Pros and Cons Accountancy Tutorials. Please again, try as much as possible to subscribe to our page for us and also share with family and friends. Whoever is doing accountancy program, being it a professional course, being it an academia, please kindly share with each and everyone to also follow us and then help us grow, whilst we also want to grow with you. So this is where we call it a close. Thank you very much for your time. Bye-bye.